It's 4:31 to let us start, Pranam bhai. So
Yes.
we can complete it in time actually.
Yes,
So,
yes, Atul bhai. Yes.
so there are many provisions in the finance bill. So we'll start. So I welcome all the participants. Please be in mute and for entire session, because when you want to speak, please raise your hand and speak. If speaker will allow you to speak. So welcome. I welcome you all to this meeting on finance bill proposals on direct and indirect tax 2022. This meeting is organized by Team Apmh. We are 35-year-old chartered accountant firm having offices at Mumbai, Roha, and Bahrain. We are into advisory, representation, and compliance practice of direct and indirect taxes, more particularly on income tax, audit, GST, company law, Companies Act, etc. We are 80 plus people team having chartered accountants, company secretary, MBS, MCOM, BCom, and article students in the team. Apmh has already published budget highlights on the day of the finance bill presented by Finance Minister. That is on 1st February 2022. We have also published our budget booklet covering direct and indirect tax proposals with in-depth analysis. We do conduct GST study circle every month covering various topics of GST, which includes recent amendments. All the interested participants are requested to be in touch with us to join monthly GST study circle meetings. Apmh is also publishing monthly GST newsletter from last 3 years. We are sure you are getting your copy of GST newsletters also. Coming to today's topic, we have joined here to understand finance bill proposals. Yes, Finance Minister Mrs. Sitaraman has almost not touched upon rate of tax consecutively for this third year. They have almost not proposed any changes from retrospective effect which are against the SSC. So we are getting very good consistency from this government. Without taking much of your time, let me introduce our first speaker of the day, who is CA Pranav Kapadia, our indirect tax partner at Apmh. He will deal with indirect tax proposals of the Finance Bill 2022, more particularly on GST. He is chartered accountant and in practice for 25 years plus now. He was president of Goods and Service Tax Practitioners Association of Maharashtra. He has advised many corporates on transaction level, and he is advising pre and post transaction level also to many corporates. He is regularly appearing before assessing officers, commissioners, commissioner appeals, VAT tribunals for litigation and representation matters. He has advised many clients at UAE, KSA, and Bahrain when VAT is introduced by those countries. With this brief introduction, let me welcome Pranav bhai. Pranav bhai, over to you. You are mute, sir.
Thank you, Atul bhai. I welcome all the participants once again on behalf of Apmh and Associates LLP. Budget 2022 did have lots of expectations from the strong government that we have at the center. And as far as my topic, indirect taxes, or more particularly GST, is concerned, when we were listing the budget, the only thing which was mentioned about GST was regarding the buoyant collection of 1,40,000 crores of rupees, which was collected for the month of January 2022, and which had come by way of a separate press note to the Honorable FM. So nothing much was mentioned about GST, and that is where we always feel that if nothing is mentioned in the budget, there are bound to be many changes which may come up in the fine print. And surely there have been many changes which have come as far as GST is concerned. We'll go through those changes. Although this is a budget which will lead us to Amrut Kal, but the way GST was envisaged, the way GST has been implemented, I really do hope that the Amrit Kal does really come in the next 25 years and GST does become a good and simple tax, because this was originally envisaged. But as of now, the way things are happening, things are developing, seems to be difficult and leading to more and more litigations. Well, I'll just share my screen and have a short presentation. I hope the screen is visible to you all.
Yes, yes. Yes, it is. Yeah.
I'll remove this. Well, as far as the indirect tax proposals are concerned, mainly if we see the amendments, it evolves around two aspects. One, we can say it is evolving around input tax credit, which is the heart of GST, and which has gone a bypass surgery, we can say, in this budget 22. So there are more and more restrictions and conditions on eligibility for availment of input tax credit. Then there are proposals relating to doing away with claiming of ITC on a provisional basis. I'll come to those details one by one. Then there is an omission of the matching concept, which was originally envisaged under GST. Then there are amendments in relation to furnishing details of outward supplies, which is generally GST or 1. Extension of time limits for credit notes. Some amendments in late fees applicability. Some amendments relating to cancellation of GST registration. Certain clarifications and timelines in respect of GST refund applications. Certain GST rate amendments, which are actually retrospective in nature and more of a clarification in nature. And some other amendments, miscellaneous amendments, which have taken place. Yeah, of course, there is one more on regarding restriction on the use of amount available in the electronic credit ledger. Full utilization of amount available in electronic credit ledger will not be allowed as per the amended section. We'll come to those details one by one. First of all, let's understand the effective dates for the amendments which are proposed in budget 2022. Now, the proposed amendments in GST shall come into force on such date as the central government may by official notification in the official gazette appoint. So it may happen, say the budget which was introduced on 1st Feb, the finance bill which was introduced on 1st Feb 22 may become an act, say by 31st of March 2022. But the provisions of GST shall come into force only after a date to be notified after the enactment of the finance bill. Okay, so thereafter, one more date will be announced, notified, and then only those provisions will be applicable. For example, the amendments proposed in GST by the Finance Bill 2020 came into act on 31st March 2020, but actually became effective from first of Finance Bill 2021 that became effective from 1st of January 2022. There are certain changes in the rate notifications which shall be effective from the date of enactment of the finance bill itself and applicable retrospectively from 1st July 2017. So some of those amendments will become operative from operative from date of enactment of the bill and apply retrospectively from 1st July. We'll come to those amendments also. Coming to the most important amendment of all is the new restriction which has been brought in section 16. Section 16, we all are aware, is the section which allows the input tax credit to be taken by the taxpayer and imposes certain conditions and restrictions on taking the input tax credit. Then there is section 17 afterwards, which is about block credits. But the basic eligibility of availing input tax credit and the restrictions thereon are coming under section 16. And in section 16, a new section, subsection BA has been inserted in section 16, subsection 2, which mentions that the dealer will be eligible for the input tax credit only if the credit has not been restricted in auto-generated ITC statements under section 38. So one more condition has been now added to the existing conditions under section 16 regarding eligibility of input tax credit. If we see the existing conditions of section 16(2), they are that the taxpayer should be possessing the tax invoice. He should have received the goods or the services. The tax charged in respect of such supply has actually been paid to the government treasury, and the person has filed his GST returns. These were the 4 basic conditions under section 16(2). Last year, in budget 2021, which was made effective from 1st Jan 22, one more condition was added last year. That is 16(2)AA, which mentioned that the details of the invoice or debit note referred to in clause A. Clause A means that he should be having that invoice, right? Has been furnished by the supplier in the statement of outward supplies, and such details have been communicated to the recipient of such invoice or debit note in the manner specified under section 37. What does this say? Now, in this section 37, in general, we should understand it talks about GSTR1. And I think everybody here would be aware of what is GSTR1. GSTR1 is the return of outward supplies made by a dealer. Basically, whatever sales are made by a dealer, sales of goods or supply of services are made by they are reported under the statement of outward supplies under section 37 in GSTR1. So 16(2)AA, what it mentioned is that not only the person should have the invoice, but the other person must have furnished the details thereof in their GSTR1. Now, 16(2)BA is going one step ahead. 16(2)BA is telling that the dealer will be eligible for the credit only if that has not been restricted in the auto-generated statements under section 38. Now, what is the section 38? Basically, and originally, the section 38 was the form GSTR 2A 2B, which we have been referring to and matching all this while. So this GSTR 2A was coming through section 38, but I think the main problem with the entire GST implementation was the defect in implementing the entire scheme of the act due to shortcomings of the portal. Now, if we try to remember that in 2017, when GST was introduced, what was envisaged? It was envisaged that there will be a two-way communication. The supplier will first mention his details in GSTR1. The recipient will get an auto-populated 2A. Recipient will check whatever defects are there. He will inform in GSTR2 again to the supplier through the portal. The supplier will get an auto-generated GSTR1A. He will again check whether the stand taken by the supplier is correct or the information or the mismatch provided by the recipient is correct, and take a decision that whatever information he has given, whether he wants to amend that those details or he wants to pay the tax, and then file a return in GSTR3. So that supplier was supposed to file a return in GSTR3. So these 5 returns were all envisaged to be interlinked, and then the final return was supposed to be filed. But as we all know, the portal could not support this entire process. And what came in was hastily introduced GST on 30th June 2017. That came with a stopgap return called as 3B. GSTR1A never came into being. GSTR2A came into being, but GSTR2 never came into operation. Neither GSTR3 came into operation. So what the government was functioning was they wanted to do the matching, but they were unable to do it because the system did not support them. They tried to introduce new single return form, which also never came into operation. They brought in section 43A, which never became operative. And the entire new process of single return under GST was also envisaged. There were so many programs, so many instructions which were given by the government, so many representations made. But again, that also failed. So now, at the end of 4 years, the government was left with the only option that the law needs to be amended to adjust to what is the existing scenario as per the portal. Like we ourselves are bound by the portal, the law itself is now getting bound by the portal. And what the portal is now exactly doing, that is what is all these changes are brought into the act now. And that is why these powers have been taken in section 16(2)(ba), that the dealer will be eligible for input tax credit only if the credit has not been restricted in the auto-generated in ITC statements under section 38. And that is the entire crux of all the changes today. And there are various restrictions which have been prescribed by section 38, which we will come to in all the details. There is a problem in all those, because what is going to happen is the entire section 38 or whatever restrictions are going to come, all of them are based on defaults made by the selling dealer, by the vendor, that is the supplier who has made the goods, and not by the recipient. The recipient is never in control of the actions or the inactions of the supplier, right? So, and the defaults, will come to those defaults. The whatever defaults are envisaged, they are all the defaults of the supplier and not the defaults of the recipient of the services. The recipient does not have control over the defaults made by the supplier. Now, in this context, let's understand a very recent judgment in the case of DY Bithel Enterprises, wherein the Honorable Madras High Court has quashed the order passed by the officer. The officer had levied the entire tax liability on the purchasing dealer without involving the seller. The payment of tax has already been made by the purchasing dealer, but the same has not been remitted to the government by the seller. This is section 16(2)(c). This speaks of section 16(2)(c), where the buyer has already paid the taxes to the seller. It is the responsibility of the seller to remit it to the government. It was held by the court that omission on the part of the seller to remit tax should have been viewed very seriously. It's a very serious offense, because the buyer is not having control over the actions or inactions of the supplier. And strict action ought to have been initiated against the seller and not against the buyer. So wherever there is a mismatch, first the action should be taken against the seller who is not remitting the tax to the government, and then only action should be taken against the buyer. But that is not happening. Whatever notices are coming of all mismatches, they are all sent to the buyer first. And then if the and maybe the department might be following up with the seller also, but it is never known what happened to the seller. Government is, whether the government is getting twice the tax, they are collecting from the seller also, they are collecting from the buyer also. There is no clarity on those grounds, right? So Madras High Court has taken this stand. This was also a stand taken during the VAT regime by the Bombay High Court in the case of Mahalakshmi Cotton and Ginning Mills. And very similar position was there, where G1, G2 mismatches were there. And there also the court had mentioned in that order that the department should first take action against the erring dealers and then only go to the purchasing dealer. But this practically, this has never happened. And in all cases, it's a fight till the tribunal, even in G1, G2 in Maharashtra, in spite of that judgment. And now, when we will see this new section 38, we will see that in spite of this judgment, more stringent rules have been made under the act. Maybe the government is, in spite of this, is trying to create one more layer. It says that whatever portal says, at first to hum wahi manenge. Whatever you want to fight, afterwards you fight. Again, in the case of LGW Industries, Kolkata High Court, it held that if all the purchases and transactions in questions are genuine and supported by valid documents, and transactions in question were made before the cancellation of registration of those suppliers. This was a case where the supplier's registration was cancelled. The SSE shall be given the benefit of the input tax credit in question. The eligible input tax credit cannot be denied to the SSE if the registration of the selling dealer has been cancelled subsequently and he has not paid the taxes. At the time of making or entering into the transaction or contract with the purchaser, the seller was registered, and hence the credit should not be denied to the buyer. Why I'm giving this points is that these are very critical issues, and the subsequent slides that we are going to see regarding section 38 wherein the entire section has been changed. It talks about various parameters which will be auto-generated into the system, into the ITC statement, and credit will be restricted. Let's see section 38. The entire section 38 has now been substituted. Section 38, which earlier pertained to the furnishing of inward supplies, is amended to remove reference to the earlier envisaged GSTR2 and replace it with auto-generated ITC statement. So auto-generated ITC statement is the nomenclature which will be used henceforth, auto-generated ITC statement. Whether it is 2A or 2B is again a point of debate, but according to me, from 1st of January 2022, as per notifications issued in December 21, GSTR 2B is going to be the auto-generated ITC statement which will be in vogue, and not GSTR 2A simpliciter. 2A is still there on statute, but while filing GSTR 3B, the information from GSTR 2B will have to be taken into consideration. This is what appears. The heading of the section itself has changed. Instead of furnishing of supplies, it is communication of details of inward supplies and input tax credit to the recipient. And when we go through the section, the entire concept of the two-way communication process of return filing has been done away with. This has also been mentioned in the memorandum issued along with the budget documents, that they have done away with the two-way communication process of filing of return, which I explained earlier. So what is happening in section 38? The input tax credit can be availed only if such credit has not been restricted in the auto-generated ITC statements. So at one point of time, section 16.2AA, which was introduced in the previous year, mentions about availing credit only if the supplier has reflected it in his GSTR1, which will be auto-populated. So GSTR1 के through credit आया वही मिलेगा, बाकी का credit नहीं मिलेगा. 16.2AA ने बोल दिया. Now 16.2BA, which is now introduced, it is telling that although it has come in 16.2 as per 16.2AA in GSTR1 in the auto-populated, still we will restrict based on the following parameters. Let's see what are the parameters. The first is claiming of input tax credit within such period of taking registration by the supplier as may be prescribed. So there could be a condition which could be put upon the recipient of the supply that the seller has taken a new registration, say within a period of time, that seller, if the buyer is claiming input tax credit from such sellers, the credit will be restricted. The rules are yet to be prescribed in this regards. So let's wait what this rule is actually going to be. There is one more possibility. Either it could be maybe new registrations they will allow after some point of time, the input tax credit, or it could be new registrations had an option of filing supplementary revised invoices, which is not available to other regular dealers. Only for a particular type of new registration dealers under voluntary who are issuing revised invoices within that 30 days time period, that is applicable in such cases. But we need to understand what these rules are going to prescribe in this. So let's wait and watch. Yeah.
Would this be applicable to the new registration, because where they would have issued the registration certificate, but some kind of preliminary checks would have been still pending, so they might give that period, and after that, still that period they would be restricting the claiming of input tax credit and over, and after that only once the
that is what appears to be. It has not been clarified in the memorandum, but that is what appears to be, that this is their plan, or maybe intention. This is the intention which appears to be, but let's wait and watch, because since the rules have not yet come in this regards. Then the second is default in payment of tax by the suppliers. So now let's understand, there is the invoice. Seller has put it in GSTR1. The recipient has got it in GSTR2B, but there is some default of tax by the supplier. 1 लाख का ये invoice है, 50,000 का उसने credit tax नहीं भरा है, so recipient will not get the credit. Now, there could be so many recipients in this case. That person might be selling goods to so many people, and only 50,000 may be outstanding, and say our bill of purchase from that particular person is having tax of 10,000 rupees. So whether my entire 10,000 will go because he has not paid 50,000, or out of that 50,000 paid, he has issued bills to 50 people. Everybody will get a proportionate. We don't know as of now how the system is going to calculate. It is all going to be based on artificial intelligence, how effective it is going to be, and how many hardships this is going to cause to each of the dealers. We'll really have to, time will tell. Then default in filing returns by the suppliers where tax payable shown in GSTR 1 exceeds in GSTR 3B. तो ये और एक कंडीशन ऐसा है कि सप्लायर का GSTR 1 में उसने समझो 10 लाख का टर्नओवर बताया है और 3B में 9 लाख का दिखाया है. Then also the recipient, say, let's see A and B. A is the supplier, B is the recipient. A has filed GSTR 1 with sales turnover of 10 lakhs. In GSTR 1 and in GSTR 3B it is 9 lakhs. So 1 lakh is short reflected in 3B. So there will be a restriction on the recipient B to claim the ITC, which will be restricted through the auto-generated statement. The statement will mention this point, or it will put in some sort of restrictions. We will have to again see how this is going to come. All this is yet to come. Then there's a default by a supplier in availing more ITC than eligible. So the supplier A was eligible for 10 lakh input tax credit as per his auto-generated statement, but he has availed 12 lakh. Then B, in his auto-generated statement, will get a restriction that A has taken excess credit. I mean, how can B have control over excess credit taken by A? So this all are going to get challenged. All these provisions are obnoxious and should be challenged in the court of law. Then default in discharging tax liability. Again, the first point, this is discharging tax liability means the net tax liability as per the returns. That is not discharged. Similar position. Then default by the supplier in complying with the provisions of section 4912. Now this 4912 is again, so this subsection 12 has been introduced in this budget, whereby maximum proportion of output tax liability that can be discharged through ITC is mentioned. Basically, this provision had come through the rules. Rule 86B was brought into statute in January 21, and whereby it was mentioned that 100% of credit available in the input credit ledger, electronic credit ledger, will not be available for utilization. Even though अगर आपके पास electronic credit ledger में 1 करोड़ रुपया भी पड़ा है, तो भी आप पूरा 1 करोड़ यूज नहीं कर सकते, 99 lakh यूज कर सकते हैं. So 99% can only be used, 1% cannot be used. The rules had mentioned, but there was no power which was given to apply those rules. That power has now been taken in 4912, which reference is now made in section 38 कि अगर वैसा अगर डिफॉल्ट अगर वो मिस्टर ए ने किया है तो भी मिस्टर बी को क्रेडिट नहीं मिलेगा. We'll come to that details of 4912 subsequently. Then one more section, section 41, which has been again entirely substituted. Section 41 mentioned about taking provisional credit of ITC on a self-assessed basis. Now in the substituted subsection 1 of section 41, the provisional word has been removed. So what is happening? This credit which is being taken, instead of provisional basis, it will be considered as to be taken on self-assessed basis only, and based on the parameters and the eligibility which are to be read along with section 16 and section 38, which we just discussed. And there's one more subsection 2 which has come under section 41, which mentions that the taxpayer shall have to self-assess and avail ITC by claiming credit and reversing thereof with interest in case the tax has not been paid by the supplier. So one more stringent provision which has come, section 16(2)(c) is already there on the record. Then in spite of section 16(2)(c), there is section 41(2) which has now come in, which says there that if the tax payable thereon has not been paid by the supplier, then the recipient will have to reverse the credit. So again, this will be again based on the entire self-assessment mechanism as per the portal generated details, and the portal will mention that the tax has not been paid by the dealer A. Mr. A might be having his own reasons of not paying it. He might have filed an appeal. He might have got a stay or something else. There could be so many reasons. But what is going to happen? The ITC reversal of the recipient will have to be done first, and he will have to reverse it and pay tax along with interest. So again, portal only will dictate what is required to be done. If you want to challenge it, I think all these provisions can be challenged in the court of law. Directly High Court में जाके writ petition करना चाहिए. And there is a maxim. It says, "Lex non cogit ad impossibilia." Law cannot compel a man to do that which he cannot possibly perform. Mr. B cannot perform the acts to be done by Mr. A. Mr. A is the supplier. He has to file the return. He has to make the payment of tax. He has to avail input tax credit. What control does Mr. B have on it? Nothing. Then how can law tell me to reverse this ITC and pay with interest? Of course, there is a provision of reclaiming it, but the rules will prescribe how to reclaim it once the other person has paid. But nothing is mentioned about reclaiming the interest paid at the time of reversal. So एक बार अगर tax interest के साथ भर दिया, tax reclaim भी किया बाद में, लेकिन interest का क्या होगा? The earlier section 42, which is now proposed to be omitted, that had provisions for reversal of interest also. But I don't see any provision as of now relating to reclaiming of interest paid for such reversals. Yeah, so these are the sections 42, 43 A, which are omitted, I think, which I already mentioned about that regarding this section and the doing away of the matching concept. We move ahead with this. Okay, then there are certain other amendments. This is in relation to GSTR 1. They have taken powers to prescribe conditions and restrictions for filing GSTR 1 and for communication of such outward supplies to the concerned recipient. So possibly in tandem with section 38, where restrictions are going to come, we might see certain restrictions which might come in filing of GSTR 1 also. We need to wait. What are those conditions and restrictions? They have not yet been prescribed. One good thing to a small extent is that there is an extension of time limit for rectification of any error or omission in respect of GSTR 1, which was earlier the due date of filing of GSTR 3B for September, which was 20th of October. Now that has been extended till 30th November. So basically it is 40 more days which will now be available. And it is now not linked to the return for the month of September. So whichever return is filed till 30th November. So for financial year 21-22, if any amendment is required to be made, that amendment is required to be made by 30th of November. Maybe it may be made in whichever month's returns that is being filed till that date. And generally GSTR 1 for the month of October will be filed by 11th of November. So practically it is 11th of November for rectification if all dealers are filing their returns in time. Because after that GSTR 1 will not be allowed to be filed. You may only give the details in GSTR 1, but it will not be saved on the portal. So practically this 30th November also I see a challenge in this. 11th November will be the actual date by which these details will have to be furnished or rectified. And the period-wise sequential filing of GSTR 1 is made mandatory. I think this we can skip. I'll not take all the amendments which are coming up in the slide. I'll only talk about the important ones. Others, I think, we'll share the. We already shared our APMH comments, and we can share the PPT also, the PDF of this PPT file. Yeah, so just as in GSTR 1, the date was extended till 30th November. Similarly, in GSTR 3B also, for rectifying any errors of earlier period, it is 30th of November. Till 30th of November, the date can be extended. Again, mind you, if you file GSTR 3B for October on 30th November, 10 दिन का late fee लगने वाला है. It is not कि आप उसकी वजह से GSTR 3B 30 नवंबर तक फाइल करें. Late fee लगने वाला है, वो लगने वाला है उसकी जगह पे. Only thing is that time is available till whatever is filed till 30th November. that will be allowed. And possibly the purpose appears to be that since the accounts are getting finalized, the tax audit and stat audits are getting completed by 30th September, in some cases by 31st of October. Hence, that differential days are available to make whatever errors, rectification of error in the month of November. Filing of GSTR1 shall be a prerequisite to file GSTR3B. So unless and until a GSTR1 is filed, GSTR3B will not be allowed to be filed. A taxpayer shall not be allowed to furnish GSTR3B for a tax period if the details of outward supplies under section 31, that is GSTR1 for the said period, has not been furnished by him. I think we already mentioned that. Okay, this is regarding issuance of credit notes. Just like in GSTR1 and GSTR3B, the date has been extended till 30th September. Similarly, for issuance of credit notes, the date has been extended to 30th November. Similarly, for credit notes also, for issuance of credit notes, the date has been extended up to 30th November. So for any sale which has been made, this pertains to sales only, sales of goods or supply of outward supplies of services. Any credit notes are required to be issued, say for financial year 21-22. If any supply has been made and for which a credit note is required to be issued, that credit note can be issued up to 30th November 2022. And one more provision, again with relating to similar extension. So all dates have been aligned to 30th of November. Extension of time limit to avail input tax credit of invoices or debit note under section 16(4) pertaining to a financial year. Similarly, there also it was based on due date of September, which has now been changed to 30th November. So for claiming input tax credit, for issuing credit notes, for filing GSTR1 and for filing GSTR3B, all the four types of activities or actions, the date has now been announced to 30th of November, extended till 30th of November. Late fees, GSTR2 late fees will not be applicable, but mind you, GSTR2 was never operative. We were getting calls कि late fee निकल गया है, late fee नहीं निकला है भाई, GSTR2 का late fee निकला है और GSTR2 किसी ने फाइल ही नहीं किया अभी तक. So it was an redundant provision which has now been made inoperative or omitted. Rather, for e-commerce operators who are required to file GST TCS returns, for them there were no late fees, but late fees have now been introduced under section 47(1) for such TCS returns also in GSTR 8. Cancellation of registration, it is only an alignment of dates in case of composition dealer who has not furnished the GSTR 4 for a financial year beyond 3 months from the due date of furnishing the said return, then GST registration is liable for cancellation. This provision was already there, but it was worded in a different manner, wherein for 3 tax periods, if the composition dealer does not file the return, then the registration gets cancelled. But this was the old provision. Thereafter, for composition dealers, the return had become yearly. It was not the annual return. Annual return is GSTR 9A. GSTR 4 has become the yearly return. 9A is almost inoperational. But if GSTR 4 is then it is not furnished till beyond 3 months from the due date thereof. And the due date for GSTR 4 is 30th April and not 31st December. So if it is not filed within 3 months, then the GST registration of such composition dealers is liable for cancellation. ये composition dealer को ही applicable था. For other than composition dealer, the power has been taken to prescribe that for a particular continuous tax period, if returns are not filed, then the registration of such taxpayer is liable for cancellation. Already these provisions were there. For 6 months, if a dealer is not filing returns, his number is liable for cancellation. But they will now prescribe it through the rules under this particular section. I think this 54, this slide is not of much importance. We can move ahead. Section 54 in relation to sales made to SEZ, wherein a refund is required to be claimed by a dealer who is supplying goods to a SEZ developer or a SEZ unit. There was a technical issue in the sense that the relevant date. See, relevant date generally for making an application for GST refund is 2 years from the end of the due date of filing the return qua that period. But as far as the SEZ sales to SEZ developers goes, it was not clearly mentioned in law regarding what should be the relevant date. In absence of that, the relevant date was being taken as the date of the generation of the invoice when the goods were sent to the SEZ unit. Now they have clarified that our intention always was to make it from the due date of filing the return for that period when the sales to the SEZ unit were made. For example, if the sales to SEZ unit were made on 10th June 2021, as of now, since there was ambiguity, the system was catching the due date as from the date of sale, that is 10 June 2021, it used to calculate 2 years. Now, as per the explanation inserted in section 54, it will be, since the transaction had happened on 10 June 2021, 20 July 2021 would be the due date for filing such return, and 2 years will be calculated from that day. Section 5410. This 5410 is regarding withholding of refund claim. So in case if a refund application is made by a dealer, but there are certain outstanding which are due to be payable by the dealer, which have been identified by the department and crystallized, not only identified, that amount is to get crystallized. सिर्फ notice आने से crystallize नहीं होता है, notice का order बनने के बाद वो demand crystallize होता है. So once the demand is crystallized and if there is any outstanding, then in the existing section 5410, there was a provision that in case there is any unutilized input tax credit against which a refund is claimed under section 54.3, then such withholding was possible. But we all know that there are other provisions of GST law wherein refund claims are applicable. The dealers can file refund applications under section 54.8 for other parameters also. There are around 8 parameters. So those other parameters were not getting covered under section 54.10. So what the amendment has sought to do, it has simply removed the reference to 54.3, subsection 3 rather, and the entire provision has become applicable to the entire section 54. 54.10 is now become applicable for the entire section 54, and any refund application which is made by the dealer, that will be subject to withholding of or recovery from the refund of the dealer. अगर कुछ भी demand है, so now the act is telling that it will withhold all such refunds. GST rate amendments. This is regarding the supply of unintended waste generated during the production of fish meal. I don't know whether starfish वाले है क्या अभी इसमें हमारे साथ. They were always telling कि sir retrospective amendment आ जाएगा, and they were very confident of it. That retrospective amendment has come from 1st July 17 till 30th day of September 2019, and such supply of such unintended waste generated during production of fish meal will be exempted from tax retrospectively. The only condition is that if such tax has been collected, the same would not be eligible for a refund. So if in that period the person had collected the tax and paid it to the government, तो उसका refund नहीं मिलेगा तभी, अभी तो वो exempt हो गया old period से, but there is the law is very clear, you cannot claim a refund for that. I think this we can skip, there is nothing in this. This is important. I'll just take 2-3 minutes more. Interest for input tax credit wrongly availed and utilized shall be levied at the rate of 18% instead of 24% retrospectively from 1st July 2017. Section 50 subsection 3 substituted. So entire existing provision of subsection 3 of section 50 has been substituted, and notification number 13 of 2017 has also been amended. The notification was basically if we see the existing 50 subsection 3, it mentioned that if there is any undue input tax credit which is taken in contravention of provisions of sections 4210 and 4310, this 42 and 43 are those sections which are omitted, right? We saw that earlier. So section 50 subsection 3 talked of those sections. If any credit has been availed, I'll just read that. If any undue or excess claim of input tax credit under those sections is taken then the dealer, the taxable person, is liable to pay interest, and that interest rate was 24%. But according to me, I think those two sections have never come into operation. And hence, even though the section mentioned that for every such mismatch, which is undue or excess claim, interest at the rate of 24% was being charged. The officers were also charging. Some companies, some dealers themselves were paying tax at the rate of 24%. But there was always a controversy in that whether 18% should be levied or 24%. And now the amendment has come in this 50 subsection 3. The notification itself has got amended, and this amendment has been brought retrospectively. So pehle ka bhi any interest which is applicable since 2017 for wrongly availing and utilizing the input tax credit, the rate of interest which will be applicable is 18% and not 24%. Now somebody will tell, अरे ये तो amendment आज आया, मैंने तो tax के साथ interest के साथ 24% भर दिया है, तो अभी क्या करने का? I think like the previous section, nothing has been mentioned in this section that you cannot claim a refund for excess payment of interest. It's worth a try, nothing to lose. अगर ज़्यादा interest भर दिया है, it's worth a try to apply for a refund for excess payment of interest. It will not be granted easily, but worth the efforts if the amount is substantial. Okay. Cash balance in electronic cash ledger can now be transferred across GST registrations of the distinct persons having the same PAN. For example, there's a company which is having its head office in Maharashtra and say a branch in Gujarat. Now there is a provision which says that there is excess cash balance lying in its electronic cash ledger. Mind you, only the electronic cash ledger, electronic credit ledger nahi. It is only in electronic cash ledger. If excess cash balance is lying, then that will be allowed to be transferred to say from Maharashtra branch to Gujarat branch, or Gujarat branch to Maharashtra branch, or as may be required. But this amendment, I understand, would only be in respect of CGST and IGST, and I don't think that they will allow any such amendment under the State GST Act, because Maharashtra State GST would be different, Gujarat State GST would be different, and if it is in the SGST ledger, such a provision will not be allowed. And when we go through section 4910, it reflects only of central tax and integrated tax. It speaks only of central tax and integrated tax, does not speak of union territory and state act. And as we have seen in this entire discussion, portal hi hamara mai baap hai, aisa hai. So now this portal has become the common goods and service tax electronic portal. Officially, retrospectively, from 22nd June 2017, the website www.gst.gov.in has been notified as the common GST electronic portal for all GST functions other than e-way bill and generation of invoices. So whatever the portal has done till now, GST portal has done, and rather there was also amendment in this gst.gov.in before 2 years. I think in 2019 they had already brought it, but now they have made that section operative retrospectively from 22nd June 2017. And subsection 12 is being inserted in section 49 of the CGST Act to provide for prescribing the maximum proportion of output tax liability that may be discharged through the electronic credit ledger. This is the point which I was mentioning, that already there is a rule 86B on statute, which says that rule 86B shall be applicable to a registered person having taxable value of supply other than exempt supply and zero rated supply more than rupees 50 lakhs in a month. So in case if your turnover is more than 50 lakhs in a month, then the registered person cannot use ITC in excess of 99% of the output tax liability for that month. In other words, only 1% minimum ITC liability, tax liability, output tax liability is required to be paid in cash, right? So this rule was already made effective on 1st January 21. It was, and now, so now the question comes whether this rule was actually operable. Are there other provisions? Section 146, 168 are already there on statute to prescribe the rules. These rules have been prescribed under those sections, but those are the general sections. now in 4910 is a specific section which relates to particularly this rule. So possibly this is one more power which the government is making itself it is empowering itself that no challenges can be made to any of these sections, and wherever in general the rules have been issued under section 146, 168, etc., they are trying to cover up that in the respective sections itself. And one last point which I wanted to mention is that we have heard so much about the cryptocurrency, the virtual digital assets. There are proposals under the income tax, the direct tax law, which Ravi will be taking up immediately in few minutes. And those proposals are there, but nothing is mentioned about its taxability under the GST law. I don't want to, as of now, comment anything on this cryptocurrency, but only mention which would be required that if the cryptocurrency is not classified as securities or money, and these are the only two things which are out of the GST net. Till that point of time, there is a full probability of GST becoming applicable on those cryptocurrencies. I know it will be a very harsh thing, 30% income tax and 18% GST on that. Because for shares transactions, the shares transactions which are speculative in nature, for them there is an STT which is applicable. They have been classified as securities. Whether cryptocurrencies can be classified as a security or not itself is a question, because the origin of that, there is no real asset or no security which is actually available qua those cryptocurrencies. So it's a very, very, very debatable question. But in case if nothing gets clarified, then there is a full probability that whatever transactions are happening in cryptocurrency, even today, without the amendment in the Income Tax Act also, there is a full probability that these are assets. These are virtual digital assets, although they are defined now, but these are virtual digital assets, and full probability that this may get taxed under the GST regime also. Well, I think this is what were the main provisions in relation to the budget. I thank you all for a very patient hearing. Questions I think we should take up at the end of the session, because Ravi is there waiting to give the insights on the income tax side, and question answers whatever are there for GST that we can take up at the end of the session. Thank you everyone for a very patient hearing. Over to you, Atul bhai and Ravi.
Yeah, thank you, Pranav bhai. It was a nice presentation on indirect tax proposals. So we have with us Ravi. I will introduce him within a minute or so. He is a chartered accountant, and with us since his articleship days. He is in charge of all direct tax returns at Apmh. He looks into TDS returns, non-corporate income tax returns, advanced tax, Bahrain and other overseas practice of the Apmh, and also cases of registrar of firm makers. He was convener of Ghatkopar Study Circle of the ICI. He has delivered lectures at various forums, including various study circles of WRC of ICI. With this brief introduction, I welcome Ravi and request Ravi to start his presentation on direct tax proposals of Finance Bill 2022. Thank you.
Thank you, sir. I hope I'm audible properly. Yes.
Yes.
Yes, Ravi.
Yes. Thanks. So yes, year after year, once again, we have the Union Budget 2022, 23, 22, 2022. Lots of hopes, lots of expectation as far as the Union Budget is concerned. Considering the 5 elections in the 5 states and whatnot, every one of us are thinking that this time there would at least be some increase in the slab rates, or some benefit in the extent increase in the limits of the benefits in ETC or interest on house property, or as the case may be. But everything put to the rest, friends, no change as far as the rate of tax is concerned, as far as individuals are concerned, or even the rate of tax for the company, corporates or firm, cooperative society, except one change in the case of cooperative society in the form of surcharge. We will deal with it. All the tax slabs and tax rate as applicable for assessment year 21-22, same were applicable for 22-23 and still going to be applicable for 20 assessment year 23-24 as well. So friends, I am straight away moving to my presentation because we have about approx 30 minutes to take care of all direct tax proposals. So what I have done is that we have bifurcated the proposals into the 3 buckets. The first is retrospective amendment which took place from effective from some certain date, like one of the amendment taking from assessment year 2005-06. Then few of the retrospective amendments, then proposals effective from assessment year 22-23, which are in the process applicable for the current year as well. Then proposals applicable from 23-24 with the next coming year. So let us take straight away the proposals which are of an retrospective effect, which is the first one is with reference to the disallowances of the treatment of the surcharge and the cess. Friends, as we all know that section 40A, which is a non-obstant clause, which states that notwithstanding anything contained in section 30 to 38, if any expenses is allowable under that section, even though it is allowable under that section, but if the conditions of section 40A is fulfilled, then it would be considered as an disallowable. One of the clause 2 of section 40A speaks that in case of payment of any taxes, which are nothing but an application on profits or gains of the business and profession, then that will not be allowed as an eligible expenses under section 37(1). However, few courts like Bombay High Court in the case of Sesa Goa Limited, and then Rajasthan High Court in the case of Chambal Fertilizers and Chemicals Limited, and even Kolkata IT80 has also held that the by considering the CBDT circular dated 18th May 1967, held that the surcharge and the health and education cess is eligible expenses against the business profits. So in order to overcome with this unexpected pronouncement as given by the Bombay High Court or Rajasthan High Court, even the Kolkata IT80, the provisions under section 40A2 brought in, and they specifically clarified that we always deem to know have the effect that it is not an eligible expenses, and the effective from 2005-06, because from that day health and education cess came, education and secondary and higher education cess came into the picture from Finance Act 2004. So this pronouncement, so rather this proposals opens a Pandora box of reassessment in all the assessments which took place where the expenses are being, where the surcharge and cess are being considered as eligible expenses. So certainly all the IT notices are going to be issued to all the assessees who have claimed the surcharge and cess as an expenses against the business profits. Another new proposal with reference to the state government employees, the benefit is extended to the state government employees effective from assessment year 2021, which is in relation to the NPS, investments into the national pension scheme of the central government. So the earlier this limit was 10%, now the limit is increased to 14%, then that too from assessment year, or rather financial year 1920 as well. It's quite possible that many of the assessee must have filed the return of income considering the 14%, 10% limit as was applicable at that point of time, and possibly the revised return may not be possible to such assessees because the time limit was till 31st March 21 to file and revised return, or the extended time period as allowed by the taxation and other amendment law. So in this case, possibly such kind of central government employees possibly will have to file an letter to these assessing officers stating that we are eligible for this refund because we considered at a lower limit, and the current proposals has allowed as an increased limit of 14% as an eligible deduction to the under section 80 CCD2. Another great relief provided on account of COVID-19, that this is nothing but exemptions of the amount received for the medical treatment on account of death or due to the COVID-19. This is also a retrospective amendment which they have brought in, that too from assessment year 2021, that is financial year 1920 onwards. The first amendment they took in section 17.2. 17.2, as we all know, friends, that this is the section which talks about the perquisites. Perquisites are nothing but, when house property is given on some without rent or with the lower rent, then rent or rent-free accommodation, as the case may be, or ESOPs being issued to the employees. Likewise, many other benefits extended to the employees of the SSC. So all such benefits are counted as an perquisites. So even the assistance given to an employee is also in order to take care of COVID-19 emergencies were also considered as an perquisite, because it is nothing but ultimately benefit extended to the employees. However, somewhere in 2021, somewhere in May 2021, the CBDT issued a circular to the effect that we won't be considered this as an taxable perquisites, but it was only in the circular form. It was not in the law form. So in order to take care of it, though CBDT pronounced in 2021, so they have issued and they have considered into the Finance Act, Finance Bill 2022, and incorporated the same in section 17.2. So any amount received by an employee on account of medical treatment for the COVID-19 illness will not be considered as a taxable sum. It is not an taxable perquisite. And accordingly, under section 56 to 10, 56 to 10 is nothing but, friends, I request the participant to please keep on mute. So accordingly, section 56 to 10, which take case of a transaction where any sum of money received above 50,000 rupees, then in such consideration, such receipt was considered as a taxable income under the recipient hands. So the benefit is also extended in case of an individual who individual or his family member. In both the scenario, friends, even in the case of salary as well as the other source, as the case may be. So if then employee is receiving a sum from an employer, his employer, then it will go to 17.2. If he is the individual receiving help for the COVID-19 COVID-19 illnesses, for the medical, any help on account of support on account of medical treatment required for himself or for the family members, then it would get covered in 56 to 10. So even in such scenario, friend, there is no limit. It's been prescribed as far as if the individual is receiving, if the assessee is receiving any help in the nature of support for the COVID-19. However, in case if the family member is receiving any assistance on the death of the assessee, okay, and that support is happening from an employer of the assessee, then in that case also there is no limit fixed. So any amount received on account of death of an employee by the family members of the assessee will be considered as an exempt income. Rather I should put it, it would not be considered as an income. Whereas in case if the sum is been given by other than employer, let us say that friends are giving, or relatives means the persons who are not coming into the definition of relative as far as section Income Tax Act is concerned, some long family members nexus, right, like that kind of thing. Then they have put a cap that up to 10 lakh rupees, if any sum received up to 10 lakh rupees, then there is no problem that however, in case if amount is received above 10 lakh rupees, then the sum would be subject to tax. Of course, from that, the expenses incurred on such treatment would be considered as an eligible expenses. But there is an additional condition which has been put here, friends, is that such sum is received within 12 months from the date of death of the assessee, either from employer or from any person other than employer. Then only this benefit is extended. Otherwise, if the sum is, say, if the assessee died somewhere in June 2020 and the payment is received now in March 2022, then the benefit will not be available. And on top of it, the government has also sought some powers through the amendments to these proposals, whereby in case if they will put more conditions, or they will place a guidelines as to how they are going to tax or how they are going to exempt a particular transaction. Moving ahead with the retrospective amendment, this is with reference to slum sale. So I am just skipping as far as the slum sale provision is concerned. Coming to goodwill is concerned, friends, this is just an consequential amendment they have carried out in the finance bill. In Finance Act 2021, the goodwill provisions were already brought in with retrospective effect from 1st April 2020, whereby they stated that we will not allow the depreciation on the goodwill, and they put up the mechanisms whereby the goodwill forming part of the block needs to be removed from the block of the assets by incorporating an proviso in section 50. So in order to give effect to that particular provision, they brought in this particular provision. So I am just running as far as this particular clause is concerned, as it is not relevant for the masses. Coming to the proposals which are effective from assessment year 22-23 is concerned, friends. As we all know that the government is committed to reduce the corporate taxation, and they have reduced the tax rate for the corporates from starting from 30% to 25%, then 25% to 22%, then 22% to 15% in case of manufacturing entity under section 115 BAB. So the one of the condition in order to avail such benefit of 15% condition was that it should be a manufacturing entity, and the incorporation of such manufacturing entity should happen on or after 1st October 2019 to 31st March 2023. So that last date they have extended to 31st March 2024. And same way, on the same parallel lines, even for the eligible startups who are claiming exemption under section 80 IAC, exemptions, that too for a consecutive 3 years out of 10 years, 100% of the profits are eligible as an exemption under section 80 IAC. Even in such case, as the provisions were getting over on 31st March 2022, so they have just extended the timelines by 31st March 23. I don't know why they are just extending this to by 1 year. They should have done this also till 2024, because by that time the government is going to be there. But unfortunately, this is the last date. Well, one of the most important provision brought in by the finance bill is with reference to an updated return, and I am sure that everyone must be very eager to listen to this new provisions of the updated return. So as we all know that as far as section 139 is concerned, we have got the original return due date under section 139(1) with reference to all corporates and assessees who are covered by the audit, that is 30th or 31st of October. In case person is covered by the transfer pricing audit, then it is 30th of November. Or in case if not falling in above category, then the due date is 31st of July of the assessment year. Even if the assessee missed this bus, then we have got the another due date, that is under section 139(4), which is called as an belated return, which assessee can file till the end of the relevant assessment year, right? Or in case if you have filed the return of income and you missed something, or some omission is happening in the original return, then the person can revise the return of income till the end of the relevant assessment year as a revised return, right? This time the government thought of to give more benefit in the form of updated return to allow the assessees to file the return of income within 2 years from the end of the relevant assessment year. Meaning thereby, if we say that assessment year 2021-22, because for assessment year 21-22, as of now, the last date to file the return is the 31st March 2022. Then in that case, if suppose if the assessee missed to file the return of income, either original, revise, it could not file the original return, even the belated return or revised return as expected, it missed the bus. Then the assessee can file an updated return till 31st March 2024. Okay, because 31st March 2022 is the last date, that is the end date of the relevant assessment year. From that date, 2 years, you have to go ahead 2 years. So March 22, 23, 24. So till March 2024, assessee can file this updated return. However, they have not given a blanket permission, friends. Here there are certain conditions still. Even the government sought some additional powers. They will put in the particular class of person or persons who may further be not available, in spite of the fact that they have already mentioned certain types of the categories of the person who are not allowed to avail the benefit of this updated return under section 139(8)(a). So moving to the second bullet, that is scheme, is this updated return scheme is not applicable if the updated return is resulting in loss return. Meaning thereby, if suppose there is a loss of 5 lakh rupees which you want to claim, then you cannot come into this updated return, because for loss return you are not allowed to file updated return. Or if suppose you have already filed the return of income earlier, and either in the section 139(1), the original due date, or belated return under 139(4) or 139(5), as the case may be, which is the revised return, and the updated return is resulting into decrease in the tax liability, meaning thereby, say if suppose your original return has got a total tax liability of about say lakh of rupees, by considering an additional income and additional tax credit and additional taxes which you have, the taxes which is already been paid before filing of this updated return, it results in decreasing your tax liability. Say now the tax liability is coming to 95,000 rupees, then you are not allowed to come into updated return. Or it results in refund, even in that scenario you are not allowed, or increases the refund. So if suppose my refund amount is 10,000 in original return, by considering the income which I have missed earlier, or if suppose I have not filed a return of income earlier, but I want to file return in updated return, so I will consider the TDS, whatever amounts which have been paid or deducted or collected as the case may be. Even if that amounts to either results in refund or increasing the refund in case I have already filed the return of income, then also I am not allowed to come under the updated returns provision. So these were the certain types or the categories whereby you are not allowed to file return of income. But there are certain types of the, or other categories of the person as well, who will not be allowed to file the return. Rather, they are not allowed to file the updated return. That is one, any search or seizure proceedings initiated against that particular person, that particular assessee in his case. In such scenarios, he will not be eligible to file an updated return for that year as well as preceding 2 years as well. Okay, so in case of search and seizure, friends, it is not only for that particular year, that assessment year. Even for past 2 years also, he has been debarred to file an updated return. Or in case if suppose search or survey is being conducted at someone else premises, but some money, bullion or documents is found at that premises which is belonging to the assessee, and in such scenario as well, the person, the assessee is also not allowed to file the updated return. Having furnished an updated return, now you came to know that some mistake has happened in the updated return. Now I want to file a revised updated return. Even in that scenario, friends, no revision is allowed as far as the updated return is concerned. Updated return can be filed only once. Continuing with the ineligible person. In case if any assessment procedure is going on either under section 143(3) or 144 or 148 as the case may be, even in such scenarios, if the notice has been communicated to the assessee that your case has been selected for scrutiny, even in such scenario, the person is not eligible to file an updated return. Additionally, AO has an information under the below acts which are mentioned below, like Prevention of Money Laundering Act, Black Money and Imposition Tax Act, Prohibition of Benami Property Act, or Smugglers of Foreign Exchange Manipulation Act. If the AO has got an information that any proceedings are initiated under this law, and the AO has sent a notice to an assessee that I am of the information, I am in the possession of an information that some defaults or the actions are initiated under this law. Even in such scenarios, you are not allowed to, the assessee is not allowed to file an updated return. Additionally, in case of information received from a foreign government, because in the double tax avoidance agreement there is a clause with reference to exchange of information, so every government makes the exchange of information with reference to a default or with reference to an assessee of the other reporting entity. So in case if any information is received and which is not been disclosed by the assessee in his return of income, even that is also not considered. And of course, the assessor, the moment the information is received which is not been disclosed, the AO will definitely send the notices to that your case is selected, or kindly explain us or he will send us a show cause. Any offences or prosecution proceedings initiated under an act, friends, as far as this offences or prosecution proceedings are concerned, even tax TDS deducted or TCS deducted but not paid and prosecution proceedings initiated, even then also the person is not allowed to file an updated return under provision of section 8A of section 139. Or this is the power which I was talking about, a person or belongs to such class of person as may be notified by the central government. So, considering that, okay, I am not disqualifying any condition, I am fulfilling the condition, I am an eligible person, no notice of assessment has been served on me. So what is the fee that I am expected to pay? So the fee, friends, in case of section 139 8A return is certainly, because I didn't came on time, so certainly they will charge something more than what under the normal regime of the Income Tax Act. So in case this is called this is called as an additional tax under section 140B. So additional tax, now here they have made two limbs. One is if the return of income is filed within 12 months from the end of the relevant assessment year, or the return of income is filed within after 12 months but before 24 months of the relevant assessment year, that is within 1 year or from 1 to 2 years. Okay, because the maximum limit is within 2 years from the end of relevant assessment year. So in case if the return of income, updated return of income is filed within 12 months from the end of the relevant assessment year, I am continuing with my that example. That is, suppose if I missed the bus as far as the assessment year 21-22 return filing is concerned. So my last date is 31st March 22, which I missed. So till 31st March 2023, if I am filing my return of income, then I have to pay, apart from the taxes, that is the regular taxes which are supposed to be made along with surcharge and cess, 25% of the aggregate of tax and interest. That is, we can put it as an additional fee which is supposed to be paid. Okay, or in case if suppose I could not file within 12 months, but I am filing after 12 months but before 24 months, then it is 50% of the aggregate of the tax and interest. So tax plus interest. Tax will include basic tax, surcharge, cess, and plus interest thereon. So 25% and 50% is the hit which the assessee will have in case if they want to file an updated return. But of course, friend, this is a very welcome provision. I will put it that in order to reduce the litigations in the country, government have thought of to let us give one more chance to the taxpayers in the form one more chance to the taxpayer, whereby they own their own give and declaration and furnish the documents. Of course, as far as the interest is concerned under section 234 A, B, C, and even the late filing fee, in case if I have not filed, if the assessee has not filed the return within the due date, that is section 139(1), okay, then the late filing fees will also be continued and would be charged. Now, as far as our original return, that is in original return or belated return or revised return is concerned, we can file an payable return as well, but the same cannot be the criteria for an updated return. If you are filing an update payable return, it would be considered as an defective return. So the updated return has to be filed after the payment of taxes only, and definitely within the 24 months from the end of the relevant assessment year. Okay, moving ahead with the proposals which are getting effective from assessment year 22-23 is concerned. That is 1st April 22 is concerned. Rationalization of provision of section 206 AB and 206 CCA to widen the dependent tax base. So as we all know, friends, that as far as section 206 AB, which brought in last year, with reference to the specified persons means an person who has not filed the return of income in for both the immediately preceding 2 years, and the tax components is more than 50,000 in his case. TDS or TCS is 50,000 in his case. So as for the reference of that 2 years is been reduced to 1 year, meaning thereby last year what used to happen, that if suppose assessee has filed 1 year and not filed second year, then he is out of the limit because he is not a specified person, because either of 2 years he has filed for 1. However, now what will happen, that if the person is not filing return of income on the due date, that is the due date under section 139(1), in case of companies 31st of October, if covered by or any other person who is covered by audit provision under an act or any other statutory law, or in case of transfer pricing 30th of November, or any other case it is 30th of July. So I am just comparing 31st of July assessees as of now. So if suppose an assessee who is required to file his return of income by 31st of July, he missed the bus, then in such case, the 206 AB double the rate, okay, double the rate as provided in the act, or rates in force, double the rate of rates in force, or 5%, right? So if suppose 10% is required to be deducted as professional fees and return could not be filed in time, so double the rate, 20% would be deducted, even though I have got the PAN, I have gotten, I have filed my return of income late, nothing doing, you would be hit by highest rate, that is 20%. So that kind of, deepen the tax base that they have done it. However, there were certain exception to that, friends, as far as this, that is section 192B in case of salary and other returns as well. So they have added to the list of exception that in case if the person is making the TDS deduction under section 194IB, in which is in relation to purchase of immovable property, or 194IB rent on TDS on the rent above 50,000 per month, or 194M, then in such cases the TDS is not required to be deducted on higher rate, that is a double the rate. So they have added to the list of exception. Moving ahead with reference to the TDS on immovable property, friends, big change has happened here. As we all know that what we used to do earlier is that in case if the agreement value of the property plus other charges like clubhouse, membership fee and all taken together is more than 50 lakh rupees, then we used to take care of the compliances of section 194 IA, and we used to deduct the TDS at the rate of 1%. However, henceforth, we will have to also take into consideration the stamp authority value. In case if the agreement value plus all charges put together and stamp duty value, either of one is higher than 50 lakh rupees, then I am supposed to, that the assessee is required to deduct the TDS at the rate of 1%. So let's take an example that let's say agreement value is say 48 lakh rupees, including charges, and my stamp authority value, let's say it is in 52 lakh rupees. Okay. Then in such scenario, friends, as the stamp authority value is more than 50 lakh rupees, my agreement value or other, including all other charges, is less than 50 lakh rupees, still I am required, as an assessee is required to make the compliance of TDS provision. And So here only the gray area which I could note is that the 10% variation is been allowed in case of an assessee. In case if suppose I am as an assessee transacting with a builder, let's say I'm 48 lakh rupees is an agreement value for a purchase of flat, and stamp authority value coming to say 52 lakh rupees. Okay, so 10% from the agreement value, then that means 4.8. If I add, then it will come to 52.8. As far as section 43 CA and section 56(2)(10) is concerned, the agreement value would be considered as the fair value as far as it is coming within the cap of 10% variation. However, such relaxation is not being given in this provision, that is section 194 IA. So even though there is an deviation within 10%, or even I could remember that in case of during the COVID period, that 10% leverage was extended to 20% for a certain period of time, of course. So in such scenarios, as per the law, we would require to make the deduction and stamp authority value. But friends, this is something which is coming from 1st July 2022 and not now. I'm just as far as section 37 is concerned, friends, I'm just skipping it, but I would like to cover the effective provision coming from 1st July 22, which is in relation to the benefit, TDS on benefits of perquisites of a business or profession. So what happened, friends, this is a general practice as far as the doctor, the pharma industries, or the gaming industries, or even the travel agents, that on achieving a certain turnover or achieving a certain number of bookings, some benefit are being extended by the company. So what used to happen, that such benefits were used to be in the form of non-monetary and were actually, and such the company who is giving such benefits used to claim a deduction as far as business expenses, because they are able to generate business out of such schemes. So in order to take care of all those aspects, friends, the TDS provision, withholding provisions are brought in even on such scenario. In case if the TDS is required to be deducted at 10%, if the value of the benefits which has been extended to the person is more than 20,000 rupees. Moving ahead, friends, another important proposals which brought in by this Finance Bill 2022. I know that we are almost near to 6, but I'll take another 10 to 15 minutes, request participants to be in the webinar. Friends, one of the biggest expectation, I would put it that way, that as far as the taxation regime for the virtual digital asset, which was one of the biggest expectation of this budget, and certainly the government thought of, and they brought in this provision, and we have before us section 115 BBH, which takes care of taxation scheme for virtual digital assets. As Pranav sir also stated that some amendments brought in for crypto assets, digital currency. I will loosely use the for the as in the cryptocurrencies for the virtual digital assets. So friends, as far as this taxation regime is concerned, what they say that no matter nothing doing, whatever income earned out of such venture, out of such activity, would be considered for 30% tax rate. Flat 30% would be subject to tax on the income part. While arriving at the income, the bill says that only the purchase cost would be allowed as a deduction, and apart from purchase cost, no other benefit would be extended. Say, for example, I have kept one machine, so there would be some electricity cost, or I have put place one person to operate on the cryptocurrency. So even the salaries will also not be allowed as a deduction. So flat, the basic, you just have to compare sale minus purchase price. That's it, and the balance income would be subject to tax at 30%. In case if suppose I made a loss, then forget it. We are not allow you to carry forward such loss to the succeeding years. If in case of loss, bhul jane ka. no carry forward provisions as far as the losses are concerned. Or if suppose I have incurred a loss in the crypto business, but I have got a profit, which is a normal business income, normal business which I have, even the set of mechanisms will also be not possible, whether it is an interhead or intrahead as the case may be. No benefit would be extended as far as the set off or the allowability of the losses versus profit is concerned. And in order to track the movement of transaction, they brought in the withholding provisions under section 194s. TDS would be deducted at the rate of 1% effective from 1st July 22 on the purchase of these kinds of cryptocurrency or the virtual digital assets. So the question comes, whether do we have to obtain an TAN credit? No, absolutely no. This is completely PAN-based compliance, which will come. Of course, the forms and the rules going to come as to how, which particular type of form will come, that will come once the bill is enacted. However, in this case, a definition has been provided of a specified person. So specified person means a person that is individual or HUF having a business or profession who does not have turnover above 1 crore rupees in case of business, or in case of profession 50 lakh rupees. Or I am a person who is not having a business income. If suppose I am a very small, so technically I am a small person, okay, I am not having any business, I am just having an income from other sources, then in such case the basic exemption limit, if suppose I am making payment to for the purchase of virtual digital asset up to 50,000 rupees, there is no need to deduct the TDS. But in case if the value exceeds 50,000 rupees, then in such case there would be requirement to deduct the TDS of 1%. Whereas on the other case, so as far as the small person is concerned, it is only individual and HUF. Whereas on the other case, that is other than specified person like company, firm, or cooperative societies, or the AOP, as the case may be, then for them the limit is only 10,000 rupees. So up to 10,000, no TDS. But in case if you are buying an crypto asset from another person, then if the consideration is exceeding 10,000 rupees, then there is a requirement to deduct the TDS. So, the way in which this virtual digital assets, itna popular ho gaya hai ki even you can discharge the consideration even by making a payment in cryptocurrency. For buying a crypto asset, you can make the payment in crypto asset. That kind of structure that this virtual digital asset has. So that's the reason this 1% TDS kind of and track. Ultimately through TDS, what happened that the government got the information that this transaction is happening, so that they can collect the taxes from the seller. Initial that yes, some benefit is extended to cooperative societies. The surcharge is reduced from 12% to 7% with a limit that if the total turnover is between 1 crore to 10 crore, which was earlier 12%, because earlier the cooperative society was subject to 12% surcharge rate in case if the profit is above 1 crore rupees. Now the 7% limit is brought in, and additionally, the alternate minimum tax, okay, that is also reduced from 18.5% to 15%. So this is the benefit which has been extended to cooperative society. And relaxation of the condition of releasing of annuity to a disabled person under section 80DD. So what used to happen that in case of a person who is disabled and the parents has taken an policy or annuity in order to take care if something happened to the proposer, that is the parents, so that from that value the dependent, that is the person who is dependent, who is a disabled person, can take care of the his life at least till the time he life. So what used to happen that if suppose the payment is received by the parents on the demise of a disabled person, then such payment or such receipt was taxable in the hands of parents in the year in which it is received. However, there was no clarity as to if suppose if the parents have attained the age of 60 or the policy is discontinued, then what would be the treatment? So in order to give relief to such an condition, this is something a kind of an benefit extended to disabled person who could not have the income in order to take care of his life. So the exemption is being extended even to dependent who receives the annuity amount either in monthly or in lump sum figure. The exemption is being provided under section 80D on the receipt of sum by an dependent. Procedures, identical question of law, and very welcome provision, I would put it, friends, that earlier there was an amendment that in case if in the assessee case there is an pending the assessment is pending before the High Court or Supreme Court, and on the identical issue the same facts, any assessment is pending before of course the other year pending before the lower authority, then based on a declaration submitted to the authority, once the order is passed by High Court or Supreme Court, the assessment could be framed based at the lower authority. But that was not the case with the other person. So here the objective is to reduce the litigation. If suppose in my case, if any assessment is pending before say High Court or Supreme Court, and similar parlance, same identical facts is in your case as well. Okay, so based on a declaration submitted to this is other way around. The revenue says that if suppose the same facts are identical in the assessee's case as well, then we will not file an appeal till the honorable courts gives the verdict. So this is a welcome provision, at least, but I don't know to what extent this would get applicable, but a very welcome move. One of the biggest change as far as the section 68 from the budget bill, the pronouncement is concerned, friends, is the additional checks for the various CATS credits in the books of accounts, forming in the as in loans or borrowings. Now, as we all know that 1668 is talking about cash credits in the books of accounts, and to the entries are found in the books of accounts not to the satisfaction of assessing officer, or explanation furnished by an assessee is not satisfactory as far as the views of the assessing officer, then they used to tax it as unexplained tax credit, and 60% tax rate post demonetization. Under section 115 BBE, they used to collect a tax along with, of course, there is an additional surcharge and cess as well. And already there is a one proviso in section 68 which talks about in case of an share capital, issue of shares by an company, then the person who is giving that is the shareholder who has given the money, has to satisfy the source of source fund. So suppose I am a shareholder, I have invested in one company. So there is an assessment in case of a company. The officer of the company has issued a notice to me that you kindly explain as that what is the source of making such investments. So that explanation as a shareholder I am supposed to make to the assessing officer, and if suppose that explanation is not to the expectation of an assessing officer, then assessing officer can make an addition as far as the receipt of share capital money which is received by the company. So on the similar line, even for the loans and the borrowings as well, friends, now the source of source is required to be satisfied. Where the earlier we used to satisfy the ICG test, that is identity, creditworthiness, and the genuineness of the transaction. That is, of course, that all those three aspects are required to be satisfied. But apart from that, the lender is required to satisfy the source of source fund, whether it is his own money he has taken on loan, or what is the exact nature of the fund. All the things needs to be submitted before an assessing officer during the course of assessment, of course, because this is actually lots of Kolkata companies has done and bogus transactions, and department is of the view that the undisclosed money is been routed into the books of accounts in the form of loans or the borrowings, and whereby undisclosed money is brought into the books of accounts. So in order to curb such practices, this provision is brought in on the statute, and this is also getting applicable from assessment year 23-24 onwards. So with this, friends, I have completed as far as the direct tax proposal is concerned. Yes, as I stated that even in the speech of the FM, the good part is that earlier we have seen the budget whereby lots of freebies have been announced to, and particularly certain tribes or a certain class of persons. All those things are being stopped. The taxpayers' money are being utilized in the correct form and are being used for the correct sense, and that's a good things as far as this current government is concerned. So with this, friends, I request Atul sir to take it forward. Thank you. In case any questions, we can take up.
Thank you, Ravi. It was nicely presented proposals of Finance Bill 2022. So before we thank both the speaker, the session is open for the questions. So you can unmute yourself and you can ask question to Pranav Bhai or Ravi, as the case may be, for indirect tax or direct tax. If you not want to speak, but you want to still ask, you can put there your question in chat box also. So no problem. Anyone?
Looks like everybody has already understood all the parameters. So no issue.
Yes. So you both have explained that very well. So all have understood that nicely, and they don't have any actually ambiguity what you have already spoken. So very good. So I think
because these things take time to digest, and as and when practically we come across situations, we really get to understand what actually is the amendment. Once we read the clause, the section, the proviso, and the impact of the amendment, and when we practically try to do that, I think that is the point of time when all more questions will definitely arise. And I think it's all whomsoever is there is a part of team Apmh or is related to or connected to Apmh. Whenever you feel that any query is there, you may definitely send a mail to either me or Ravi or any of the partners at Apmh, and we will try to solve your query as to the best of our abilities as possible.
Yes. So we thank all the participants who have joined today. You have spent time with us, and we are happy that you have that eager to learn the what budget or finance bill is stating. So we are happy, and we thank you all for attending this. I thank both the speaker Pranav Bhai and Ravi for nicely presented finance bill 2022 proposals. Thank you all.
Thank you very much.
Thank you.
Thank you
everyone.